So I've shared this before, but I think it's prudent for me to share it again because I do get questions a lot on Twitter or on YouTube as to why I'm investing in SPY over IVV or VOO. And the answer is really simple, and it might not necessarily pertain to you, so I hope you pay attention. I do a little bit of covered calls. I'm not a master at it. I don't sell too close to the money or anything like that. But if you take the opportunity, which I'll show you guys in just a second, to look at the expiration dates, the quantity of expiration dates, the strike prices, the quantity of strike prices, you'll see that SPY is superior in the ability to get the flexibility of option that you want to employ over the next week, 2 weeks, a month, or what have you. Whereas IVV, while it does sell weeklies now, which I think is a step improved, the strike prices are still few and far between. They go by $5 increments, and VOO only sells monthlies, and that also goes by $5 increments. And so in that respect, you're not going to get nearly the flexibility. So let's just take a quick moment to reflect. SPY has approximately 0.2% annual expense ratio. VOO and IVV, I think, are in the 3.03, 0.04% range. Might even be lower at this point because they do try to lower it about 0.01% every few years or so. So that's a pretty big difference. But to me, I never had luck writing on IVV. I never had luck writing on VOO. The ability to write on SPY, I've had a lot of success. I've yet to have any shares ever called away. And just over the past week alone, actually past several weeks alone, I made a couple $100 writing covered calls that ended up being expired. And that couple $100 more than pays for the difference in expense ratio. So for me, if you were able to continue that over the course of, say, a couple months or a year, it's way going to outperform comparatively to IVV and VOO, the covered call income that you're going to generate. Now, it's not going to be 20% more, or it's not going to be 50% more. But what it might do is it might double the amount of dividends in kind of respect that you're getting, because you're getting about a 1.2 to 1.5 yield from all these S&P 500 funds. You might be able to, say, get another 1.5 or 2% by writing these covered calls. You might not have the flexibility to do that with IVV and VOO. So while you are incurring, let's just say, for example, 0.15% more expense ratio, you're able to make up for that and fully offset it by over 1% of additional. Yes, it's going to be more work, but at the end of the day, 1% additional income a year off of a portfolio means you only need to be investing in companies that are yielding, say, 3% with additional covered call income of another additional 1%. You get your 4% a year. So if you're retired, it might be beneficial for you. So it just gives you that extra flexibility. So before I continue to beat that with a fucking bat, let's just jump into looking specifically at the SPY call side. So we're going to look a month out instead of trying to compare week to week, because obviously VOO doesn't have that ability to compare week to week. We're going to go October 21. It's going to be the October expiry. But if you do open up all the SPY expiries, you can see you have weeklies, you even have sometimes 2 to 3 times a week expiration dates. But just because we're trying to have a decent comparison between all the three, let's just look at the monthly for October. So I generally speaking write at the 4 or 5 delta, and this just gives me a little bit of happiness because I don't want my SPY shares to get called away. It's the golden goose that keeps on printing money. So yes, VOO, IVV, SPY, they all are slightly different prices. You have VOO being $360, IVV being $394, and you have SPY being $393. So IVV and SPY are basically the same. But what I'm going to be doing is looking for a 4 or 5 delta and how much money I'm going to be getting. And generally speaking, they should be all about the same. I can pull up a spreadsheet, do a bunch of fanciness, but you guys can kind of compare like for like, right? If you're looking at a 4 or 5 delta for basically the same share price within 10% of each other, you should be getting about the same amount of premium on a monthly covered call, right? So let's just look at this 443, which, it's not necessarily a 4 delta. If I were to open this up, the delta might be a little bit different. Let's just see. It's a 4.5 delta. So 4.5 delta gets you about 48 cents. Yeah, that's not too bad, right? I mean, you walk away with, 0.1% for a month's worth of work, just kind of hanging out, being so far away. Hopping over to, say, VOO, let's look. You only have monthly opportunities to kind of look at, so few and far between. And let's look. Oh, wow. You jump from, let's just say, a 6 delta to a 4.5 delta to a 2.5 delta. So you're jumping like 1.3% or 1.3 delta every time you move up like a strike, because you're going by $5 increments instead of, say, these single dollar increments. Now, if you were to compare, say, jumping to this 442 for SPY, you're at a 5 delta, and then we were looking at the 443, right? You're looking at 0.25 delta difference, 0.0025, I mean, but I generally just like to call them by the hundreds. So yeah, what would you get for, let's just say, this delta? 30 cents. So it's a little bit lower of a delta, 439, versus the delta we were looking at for SPY, which is 473. Got it. You're getting way less. Okay, so what about this one? Here's 439. 439 for 439. Boom, 44 cents. What are you getting for VOO? 30 cents. And there's so little liquidity in these options, it might jump from 30 cents to 40 cents, back down to 20 cents. Whereas you could just look at the volume, one was traded over the course of the day. Whereas if you were to go to this 444, this 443, where we're at, 444 was traded at 310 today. A lot more open interest. So the ability for you to get this option and sell it is a lot better. Now let's jump over to IVV. The thing that I do like about IVV, it's selling weeklies now. I don't remember back in the day. It's selling weeklies, so that's cool to be able to see. Because generally speaking, when I sell my SPY options, I don't do a month out because the peaks and troughs are generally a month, month and a half. I like to do weeklies. So that way I get more repetitions. And then also I feel like if I did a monthly, if there's a month long or month and a half long bull run, like we kind of had from the end of June to mid-August, you're not going to get caught in that, right? And I've had that happen before in a bunch of different other stocks, but companies I don't want to get called away, I try to do weekly options for that reason. So then looking for similar 4 to 5 deltas. This is 7. This is 4. This is 5. So you can kind of see on this IVV at this 4 delta, you're looking at 10 cents. Let's go a little bit closer. You're at a 5 delta, you're looking at closer to 40 cents. So you're getting a little bit closer, and you're not getting nearly the amount of premium. And if you wanted to, say, roll or do anything, you don't have that flexibility. So it's like you're going from 10 cents to 40 cents to 70 cents for contract, and you're going up in, basically $5 increments, whereas you have this ability to maneuver easier utilizing SPY. Now, what I want to iterate is this isn't for everybody, right? This isn't saying like Joe Schmo with 2 shares of SPY or 2 shares of VOO should be like, I'm selling my VOO or IVV today and moving to SPY. You have to keep in mind, I have a larger portfolio. I'm trying to get closer to 1,000 shares of SPY so I can do 10 contracts a week. Currently doing 2 contracts a week. So the ability for me to pay for my expense ratio very quickly is pretty simple. And I'm going to continue to take some of the individual security positions that I have that have done well, For example, I sold Exxon in the 90s, moved some of that Exxon to SPY, moved some of it to other oil and gas companies I believe in more. And I'll probably do the same with Caterpillar when I believe it's an appropriate price. Probably sell a portion of that, put it into SPY, portion of it, and solidify some of my other opportunities that I believe in as well. But I wanted to share that with you guys because I get asked that question quite a bit. And I think it's a good little piece that you can kind of see. Expense ratios, while nice, aren't necessarily the be all end all. And just like dividend yields are nice, but not necessarily the be all end all. Every metric in, say, characterization is just that, a metric. It's not the metric. And so PEG ratios and stuff of the like might matter to you, but it might not necessarily matter to somebody else. It might matter to, say, a trader when you're looking at, say, implied volatility, crush, or something like that. But for somebody that's just selling theta month over month, yes, the IVV piece comes into play. But if you're selling over the course of, say, 30 to 45 days, like it's generally, if it's like single individual securities, more so what I do, rather than SPY or like my high growth companies, I like to sell weeklies. You know, you might just be looking at your theta decay a month out or 45 days out and trying to get a pretty good cushion, look at your technical analysis. Whereas some people, they just want a super low IV, so if it explodes, you know, over the course of the next 2 to 3 days, they can sell that option for, say, 200, 300% and go from a $2 option to a $6 option, right? It all depends on what kind of person you're trying to be, what kind of trader you are. Are you buying premium? Are you selling premium? To me, just selling premium is always done better. So there's that. But it just goes to show you that just because a metric says something doesn't mean it's the be-all, end-all. And hopefully this gives you a little bit of opportunity to kind of think about some things. And I know some folks are going to jump at me because I'm not the best at options, and you're probably just going to be like, Matt doesn't know what the hell he's doing. Probably right. I mean, there's probably some people that are traders. I don't really trade all too much. I trade my weekly my weekly SPY options, cover calls, and that's pretty much it. Palantir, I'm not selling any cover calls down here because it's too low of a price. So yeah, I mean, I have my Google, my Amazons that I sell on, Pepsi I sell, Johnson & Johnson I sell. But those Pepsi and Johnson & Johnson, I don't sell weeklies. I sell monthlies, generally 45 days out. Amazon I just bought back, sold for October. So yeah, anyway, I'm going to ramble at that point, but hopefully this helps. Let me know if you need any discussion points in the comment section down below, and I'll see you guys in the next video. Cheers.